This video is on Chapter 21, Flexible Budgets and Standard Cost. I will review alternate exercises 21.3, 8, 9, 10, and 18. The first one is 21.3. So here we're given some information about this company's budgets and their normal cost. We want to compute the total variable cost per unit, total fixed cost, and prepare a flexible budget at two different activity levels. So we're looking at their cost information, and we need to determine which of these costs are variable and which are fixed. Direct materials, as you know, and direct labor are variable cost along with indirect materials. The supervisor's salary is a fixed cost. Sales commission and shipping are variable cost. The administrative salaries are fixed. Depreciation on the office equipment is also fixed. Then we have insurance fixed and the rent also. We will get totals here. The total fixed cost will be $165,000 and the total variable cost will be $300,000, and we can divide by 5,000 units to get a cost per unit. The total variable cost per unit is 60. This shows us what our costs will be if we sell 4,000 and also if we sell 6,000 units. So our sales, $200 times 4,000 is 800,000. Variable cost we said was 60, so 4,000 times 60 is 240. Subtract to get the contribution margin. Subtract out our 165 fixed cost to get our income of 395. At the 6,000 unit level, again, we'll take 6,000 units times 200 and then 6,000 units times 60. Subtract to get the contribution margin, subtract our 165 fixed cost. And if we sell 6,000 units, we will have income of 675,000. Now we want to look at this in a little more detail. So we want to look at each item individually and what the cost is. For all the variable cost, we need to take the total. Direct materials total is 100,000 and divide by the 5,000 units. So 100,000 divided by 5,000 is 20. Then to get the amount for 4,000 units, we take 4,000 times 20. For 6,000, 6,000 times 20. We'll do the same thing for our other variable cost. The total cost divided by 5,000 units. Then we'll just get our per unit amounts and multiply by either the 4 or 6,000 units. We'll list all of the variable costs first, and you can see that the total variable cost is what we computed before, $60 per unit. Subtract from our revenue to get our contribution margin. Then we'll just list each of the fixed costs, which came in total to 165, and subtract that to get our income. This is exercise 21.8, the alternate version. And we want to prepare a standard cost so we can see how much does it cost to produce each unit. We want to look at the total budgeted cost for June, compute the total actual cost. Here are the actual results, and compute the total cost variance for June and determine if it's favorable or unfavorable. Let's take a look here. These are the standard costs. So for each unit, it should take 4 pounds of material at $5. The actual results are that they paid $510. So we know we're going to have an unfavorable price variance here. For labor, it should take 3 direct labor hours at $15. Well, they paid $15.08. So that also means the price for labor will have an unfavorable variance. And since it's supposed to take 3 direct labor hours and they made 5,000 units, 5 times 3 is 15, should have taken them 15,000 direct labor hours, but they did it in 14.8. So part of the labor variance will be favorable. And then here is information on our overhead. Overhead is based on direct labor hours at $18. This is our standard cost per unit. Just bring this information here. 4 pounds at $5. That's 20. Labor is 3 hours times 15. Overhead is 3 at 18. So the total cost to make each unit should be $119. They produced 5,000 units. You can see that here. How much should it take to make 5,000 units? 5,000 times 4 pounds for direct materials times the standard of 5. So it should take $100,000 for materials. Labor, actual units times 3 direct labor hours times 15. So they should have spent $225,000. Overhead, they should have spent $270. To make 5,000 units, it should cost them $595,000. Here are the actual cost. So they come from here. 20,200 pounds times 510. Direct labor, 14.8 times 1580. Overhead, they told us, was 274. We'll add them together so you can see their actual costs are higher than what it should have taken to make 5,000 units. Our total cost variance then is 610,860 minus 595, 15,860. It's unfavorable because they paid more than what the standard was. Now we're going to compute the direct materials price and direct materials quantity variances. Here's the standard. It should take 4 pounds at $6. And they used 21,000 pounds to produce 5,000 units. 5,000 times 4 is 20. They should have used 20,000 pounds, but they used 21,000. The standard was $6 per pound, and they paid $6.30. So we can see 2 of these variances will be unfavorable. Here are the formulas. All you have to do is plug the numbers in to these formulas. Actual quantity, 21,000. Actual price, $6.30. Multiply those together. Actual quantity, again, 21,000. Standard price was 6. Multiply. Get the difference. This is a price variance. You can see the quantity is the same because we used actual quantity. They paid more than the standard, so this one will be unfavorable. And this is another way of computing that variance if you want to plug the numbers in here. For standard cost, again, they made 5,000 units. It should have taken them 4 pounds. The standard quantity allowed is 20,000 pounds to make 5,000 units. Standard price is 6. Multiply those together and subtract from the 126. Actual quantity here was greater than the standard quantity, so this one also is unfavorable. This is another way of computing the materials quantity variance. When you have two variances that are the same, meaning either both are favorable or both are unfavorable, then you add them together. If they're different, then you subtract. The 6,300 unfavorable plus the 6,000 unfavorable gives us total of 12,300 unfavorable. Now we're looking at the direct labor rate and direct labor efficiency variances. Here are the formulas. We're looking at this row for the labor. List the actual hours, 27,000 times the actual rate paid, 1840. Multiply those together. Again, list the actual hours. The standard rate was 18. They paid 1840, so we know this one's going to be unfavorable. For the standard hours allowed, they made 5,000 units. Each unit is allowed 6 hours. 5 times 6 is 30, so they should have spent 30,000 hours, but they only spent 27,000, so this efficiency variance will be favorable. The difference between these two numbers. Now that we have an unfavorable variance and a favorable variance, we'll subtract, and whichever one is larger, that's what the total variance will be. 54,000 minus 10,800 is 43,200 favorable total direct labor variance. We're looking at the overhead variances now. Their standard is 70% of their productive capacity. They should make 56,000 units. They only made 54,000. This means this overhead variance will be unfavorable because they should have made 2,000 units more than they actually made. This is our budget amount. Variable cost should have been 336. Fixed overhead should be 134.4. So the total overhead at 70% capacity, in other words, making 56,000 units, should be 470,400. Also, the standard allocation base at 70% capacity is 67,200 direct labor hours. That is computed as 56,000 times 1.2 direct labor hours per unit. So it should take them 67,200 direct labor hours to make 56,000 units. The variable overhead rate then is 336 divided by that 67.2 to get $5 per direct labor hour. The fixed overhead rate will be the 134 also divided by 67,200 to get $2 per direct labor hour. So this is how much it should cost per unit to make the 56,000 units using 67,200 direct labor hours. Now we want to use this information to figure out what it should have cost them to make 54,000 units, because they didn't make 56, they only made 54. First of all, how many direct labor hours should it have taken them to make 54,000 units? Multiply 54,000 times the 1.2. And multiplying that by the total of $7 per direct labor hour means the total they should have spent would be $453,600. Here are the actual results. So they spent more than what it should have taken them. The total overhead variance then is the actual cost, $465,600, minus what it should have taken them to make 54,000 units, $453,600. They have an unfavorable variance of 12,000. Now we will look at the separating this variance into the volume variance and the controllable variance. The volume variance is the difference between the standard overhead applied, which is here. This is what it should have taken them. 54 actual units times the 1.2 times $7, $453,600. The flexible budget, based on their actual results, is listed up here. This is what it should have taken them. $458,400, 54,000 units times the 1.2 direct labor hours is the 64,800, and then this is separating out the variable and the fixed portion. The variable portion was $5 per direct labor hour. 64,800 times 5. The fixed is a number here that should be the same regardless. That's why it's called a fixed amount. To compute the volume variance, we will subtract the flexible budget from the standard overhead applied to get 4,800 unfavorable. Then we'll get the controllable variance, which is the difference between the actual and the budget based on 54,000 units. That gives us 7,200 unfavorable. If you add the unfavorable volume variance plus the unfavorable controllable variance, you get the total overhead variance of 12,000 unfavorable. Your last question at Connect for Chapter 21 is a Tableau assignment. And make sure to use the exercise template in Blackboard to help you complete your homework questions. This concludes the Chapter 21 alternate exercises.